Have you ever been caught off guard at the checkout, a $50 bill in hand, only to be met with a polite but firm refusal? This scenario is becoming increasingly common across America. From big box retailers to mom and pop shops, businesses are increasingly hesitant to accept large denomination bills, leaving some customers frustrated and confused. This shift away from cash, particularly larger bills like 50s and 100s, signals a potential change in how we transact. While the transition to a more digital economy has been underway for years, the recent increase in cash rejection policies brings the debate to the forefront. What's driving this trend, and what does it mean for the average consumer? The reasons behind this trend are multifaceted, ranging from concerns about counterfeit bills to the desire for faster, more efficient transactions. As we delve deeper into this issue, we'll explore the motivations of both businesses and consumers, examining the potential benefits and drawbacks of a society that increasingly relies on electronic payments. Join us as we navigate the evolving landscape of currency and commerce in the 21st century. Imagine this. You're at your favorite lunch spot, ready to pay for your meal, only to find a sign stating "card only." You reach into your wallet only to realize you have cash, but no card. The frustration sets in as you realize you might have to leave without your meal. For many consumers, encountering such signs has become a frustratingly common experience. It's not just about the inconvenience. It's about the sudden realization that your money, in its physical form, is no longer welcome. The shift away from cash, particularly high-denomination bills, is leaving some feeling excluded and inconvenienced. Imagine holding a crisp $100 bill only to be told it's not accepted. The feeling of being turned away despite having the means to pay is disheartening. The reliance on cards, while convenient for many, presents a significant barrier for those who operate outside the traditional banking system. It's easy to forget that not everyone has access to credit or debit cards. Millions of Americans remain unbanked or underbanked, relying primarily on cash for their daily transactions. For these individuals, cash is not just a preference, it's a necessity. For them, the refusal to accept cash is not just an inconvenience, it's a barrier to accessing essential goods and services. Imagine needing to buy groceries or medicine only to be turned away because you don't have a card. "I felt discriminated against," shared one shopper who was turned away from a clothing store for attempting to pay with a $50 bill. This sentiment is not uncommon. It's like they don't trust people who use cash anymore. The mistrust and judgment faced by cash users can be deeply unsettling. This sentiment is echoed by many who feel judged or inconvenienced by increasingly strict cash policies. The conversation around cashless policies is growing, with many voicing their concerns. The transition towards a cashless society, while seemingly inevitable, must be approached with caution and consideration for those who rely on cash. It's not just about technology, it's about inclusivity and fairness. As we move forward, it's crucial to ensure that everyone has equal access to goods and services, regardless of their preferred payment method. A truly inclusive society must cater to all, ensuring that no one is left behind in the rush towards digital transactions. While digital payments offer convenience and speed, cash remains a vital part of the economy for many. Balancing both methods can ensure a smoother transition and greater acceptance. Community discussions and feedback are essential in shaping policies that work for everyone. Listening to those affected by cashless policies can lead to more inclusive solutions. Ultimately, the goal should be to create a payment ecosystem that is flexible and accommodating, allowing individuals to choose the method that best suits their needs. By fostering an environment where both cash and digital payments are accepted, we can ensure that everyone feels valued and included in the economic system. The journey towards a cashless society doesn't have to be exclusionary. With thoughtful planning and consideration, we can navigate this sea of card-only signs together, ensuring a fair and inclusive future for all. Major retailers are often at the forefront of policy changes, and cash acceptance is no exception. As the world moves towards digital transactions, the policies surrounding cash usage are evolving rapidly. Companies like Walmart, Dollar Tree, and McDonald's, with their vast reach and influence, play a significant role in shaping consumer behavior and expectations. Their policies not only affect millions of customers daily, but also set trends that other businesses often follow. Understanding their specific cash policies offers valuable insight into the broader trend of high-denomination bill rejection. This trend is driven by various factors, including security concerns, the need for efficient cash handling, and the push towards a cashless society. Walmart, the nation's largest retailer, has long grappled with cash handling issues. With thousands of stores across the country, managing cash transactions efficiently and securely is a significant challenge. While they officially accept all denominations of U.S. currency, individual stores retain the right to refuse large bills at their discretion. This policy aims to reduce the risk of counterfeit money and streamline the cash handling process. This often translates to inconsistent policies across locations, leaving customers unsure of what to expect. Some customers may find this frustrating, especially if they are unaware of the specific policies at their local store. Dollar Tree, known for its everything for a dollar concept, has also implemented policies limiting cash transactions. Given the low price point of their items, handling large bills can be particularly cumbersome. Some stores have set maximum purchase limits for cash payments, encouraging customers to use cards for larger purchases. This not only speeds up the checkout process, but also reduces the amount of cash on hand, which can be a security risk. Fast food giant McDonald's, while primarily a cash-heavy business, has also adopted varying cash policies across its franchises. The nature of fast food transactions, which often involve small amounts of money, makes cash a convenient option for many customers. Some locations have implemented exact change-only policies during certain hours, citing security concerns and staffing limitations. This policy helps to minimize the need for cash handling and reduces the risk of errors or theft. These examples highlight the complex and often inconsistent nature of cash acceptance policies. As businesses strive to balance security, efficiency, and customer satisfaction, their approaches to cash handling continue to evolve. As retailers navigate the challenges of security, efficiency, and customer experience, the way we pay for goods and services is likely to continue evolving. The future may see even more innovative solutions, such as increased use of mobile payments, digital wallets, and other cashless technologies, further transforming the retail landscape. While the inconvenience of cash restrictions is evident for some consumers, it's essential to understand the motivations behind these policies. These restrictions are not arbitrary. They are carefully considered measures that address a variety of challenges faced by retailers and businesses. Retailers face numerous challenges when it comes to handling cash, from counterfeit prevention to the logistical complexities of storing and transporting large sums of money. The physical handling of cash requires meticulous attention to detail and robust security measures to ensure that every transaction is legitimate and secure. One of the most significant concerns for businesses is counterfeit currency. Counterfeit bills can easily slip into the cash flow, causing substantial financial losses and complicating the accounting process. Sophisticated counterfeiting operations pose a real threat, and accepting large bills increases the risk of financial loss. These operations often use advanced technology to create nearly indistinguishable fake currency, making detection difficult and costly. By limiting cash transactions, particularly those involving high-denomination bills, retailers aim to mitigate this risk. This policy helps to reduce the likelihood of counterfeit bills entering the system and protects the business from potential losses. Processing time is another factor driving the shift towards card-only policies. Handling cash, especially in large amounts, can be time-consuming and prone to errors, which can slow down the checkout process significantly. Cash transactions, especially those involving large bills, can take longer to process, leading to longer wait times and frustrated customers. The need to count and verify cash, provide change, and ensure accuracy adds to the delay. Electronic payments, on the other hand, offer near instantaneous processing, improving efficiency and customer flow. With a simple tap or swipe, transactions are completed in seconds, allowing for a smoother and faster checkout experience. Additionally, the increasing cost of labor and security associated with cash handling plays a role in retailers' decision-making. The need for secure storage, regular counting, and transportation of cash adds to operational costs. From armored car services to employee training, managing large volumes of cash can be expensive. These costs can add up quickly, making cash handling a less attractive option for many businesses. By encouraging card payments, businesses can potentially reduce these overhead costs. The reduction in cash handling can lead to lower expenses related to security, labor, and transportation. Understanding these motivations sheds light on the complex calculus retailers face when implementing cash policies. It's a balancing act between providing convenience for customers and managing the practicalities of running a business efficiently and securely. While the convenience of consumers is a factor, it's often outweighed by concerns about security, efficiency, and cost-effectiveness. Retailers must weigh the benefits of cash transactions against the potential risks and costs, leading many to adopt card-only policies as a practical solution.